Lyft stock is up 63% year to date. However, if we zoom out, the stock is down 51% in the past 5 years. So let's see if this is a good opportunity to buy the company by looking at the fundamentals and running a DCF model to calculate the intrinsic value of the company and potential future returns. The company's market cap is $8 billion, and if we look at revenue, it has grown incredibly fast in the past decade, growing from $343 million to $6.2 billion. Analysts are expecting revenue to continue to grow, although at a smaller pace. They are expecting Lyft to reach $7.5 billion this year and grow to $10.2 billion in 5 years. I personally believe that they are going to grow at a faster pace because in their last earnings, active riders grew 18% to 28 million, quarterly rides grew 15%, and gross bookings 16%. And they are expanding into new geographies. Regarding profit, this company recently turned profitable and they are generating $150 million in net income. However, they have a lot more free cash flow, which is great, currently at $1 billion. And they have great margins as well, with gross margin around 35% and free cash flow margin around 16%. Moreover, in their guidance, they said that our free cash flow generation remains robust and we expect to deliver well above $1 billion in 2026 again. This amount of free cash flow is great, and Lyft is now trading at a price to free cash flow of 8, which looks really cheap. But in order to calculate possible future returns, I use my Google Sheet. I did a 7-year analysis with low, middle, and high assumptions. And according to my low assumptions, you would get a 19% annual return on your money, middle 28%, and high 36%, which are amazing returns. As far as my assumptions, I assume Lyft grows revenue 6% annually on my low assumptions, 8% on my middle, and 10% on my high. The average profit margin and free cash flow margin for the next 7 years between 13 and 19%, and I assigned a P and price to free cash flow at the end of the 7 years of 16, 18, and 20. But if you want to make your own assumptions, I'm going to leave a link to the spreadsheet down below. It is super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. Moreover, Lyft has an exceptional balance sheet with $1.9 billion in cash and $1.3 billion in debt. But now let's move on to the risks because I found a couple. Number 1 is competition. Lyft's main competitor is Uber, which holds a significantly larger market share in the US. And risk number 2 is the share dilution. They have been issuing a ton of shares in the past years. This is horrible for investors because you own less of the company and share the profits with less people. In fact, if we go back to the spreadsheet and we assume they issue 2% of their shares annually, the returns become considerably less. I believe it is worth starting a small position in this company because the valuation looks too cheap to ignore, but keep in mind there are tons of risk of investing in this company. Lastly, if you want a discount on stockanalysis.com, the best place for stock data, grab my code in the description. I hope you found this video valuable. Let me know what you think about Lyft stock in the comments, and I'll see you in the next one.